All right. Well, good afternoon, everybody. Welcome to the Q4 2024 market commentary, where we'll discuss a few things between now and the end of the year, and then also what's transpired over the last quarter, Q3. And so, once again, thank you for joining us here on a Wednesday, not so gloomy day. We'll jump right into it. So three things we're going to talk about today. So number one, again, Q3, we're going to talk a little bit about the markets. A lot of things have happened over the last 3 months. And again, what does it actually look like for the balance of the year? What should we be considering? I can't believe we're already almost midway through October. We really only have about 10 weeks left of 2024, and it's been a overall pretty good year actually in the markets, despite some of the up and down volatility that we've seen in the last couple of months. We're going to talk about interest rates. It's been a common theme since I've been doing these for the last couple of years. The US Fed cut for the first time in 4 years. So we'll talk a little bit about what we anticipate for the balance of the year and into 2025. And then the last one, and obviously this is top of mind, but what do we expect with the US presidential race? Less than 30 days away. Obviously, we have an election here in Canada as well, but it's not going to drive the markets as much as what's happening down south. So I'll provide a few comments there. And then I forgot to add one piece, but we'll talk a little bit about some year-end tax planning considerations. So what maybe you should be considering before the end of the year if you want to get anything taken care of prior to us getting into 2025. So as you know, for those of you that have attended these, I generally start off with something like this. And I thought this was actually interesting because most investors, most Canadians, they fall into one of these two categories. There is a lot of volatility that, coming into Q3 made people kind of reassess their portfolio and the balance of the year. It was kind of a little bit of a shock to the system. It's quite steep and severe. And then we have the flip side where we have folks that are saying, hey, I don't want to miss out, especially with the Mega 7 stocks. Everybody's kind of jumping on the bandwagon as they're at their peaks. And over the last quarter, they haven't done especially well since the markets have peaked in July. So let's go back to where the markets again peaked in July, and let's look at what's transpired since then. So I don't know if you recall, I sent out an email shortly after the peak. And what I talked about is I said, hey, we've gone through a period of time where we haven't had, or the markets haven't had any significant drop of greater than 2% in over 356 trading sessions. Okay, and this is substantial. We actually haven't seen this since 2017, 18, and before that, it was in the early 2000s, 2004, and 2006. So as investors, we have recency bias. We haven't seen any significant declines or, on a daily basis in the markets, and we generally get a little bit comfortable. And then when we get some volatility, it's a little unnerving because we kind of forget that markets in general go up and down. It's just we've had an extended period of time up to the middle of this year where we've had no declines greater than 2%. Well, shortly after hitting the peak in July, after the long weekend on August 5th, we saw one of the biggest volatility spikes that we've seen in the last 30 years. And we saw the markets fall significantly in a short period of time. And if we go back, what this chart shows you, it shows 2008 financial crisis. This here is the VIX. The VIX is an index that tracks volatility. And the higher the number, the higher the volatility, the implied volatility in the market. So if we all go back, 17 years ago to the financial crisis, it was a really uncomfortable time. We had a lot of volatility in the markets, both here in North America and global. And as a result, the volatility index spiked to the highest it's been in over 30 years. Okay. And then we fast forward during the COVID pandemic. And here we are right here in the COVID pandemic. And that was the second highest volatility meter that we'd seen since the great financial crisis. And after that, again, you see this is just normal volatility. But on August 5th, we hadn't seen volatility in the market again, since the 2020 COVID pandemic or the 2008 financial crisis. So in one day, it was a stark reminder that there's definitely some underlying issues that are within the market. Okay, so it made a lot of folks go back and reassess their portfolio. It reminded them that, again, markets go up and down, and it was an opportunity for people to reassess their comfort level of risk. Now, for us, for our clients that are on this call, you know that we prepare for these types of events or situations rather than react when they happen. So for a lot of our portfolios, we've anticipated volatility at certain times within the year, and we've designed the portfolios in a way that we want to minimize the downside, but we also want to capture the upside as well. And that's exactly what's been happening over these last number of years. So when we go back to volatility, this is just the S&P TSX. This is just as a reminder for you that are on the call that volatility is natural. It's part of the market. And what this chart shows here, again, this goes back over the last 20 years. But what it does is it actually shows the S&P TSX, the return year over year since 2005, whether it's positive or negative. But it also shows the largest peak to trough decline within a year. And so what I mean by that, if we go back to 2008, back here, okay, this was the financial crisis. Well, we can see the markets from top to bottom in 2008 fell 49%. And that's what I was saying. It was very uncomfortable. But even all the other years that are positive, we've still seen contraction. So here's 2009, which would have been early 2009. We would have seen a 20% decline, but markets finished up 31%. Okay. And you can look at any of these different years. Go back to 2020, COVID, markets were flat on the year, but they fell as much as 37%. Okay. And even in 2022, which was the first bear market that we had seen in almost close to a decade, the market had fallen roughly 20% for the year, but finished down 9%. So again, the volatility is very, it happens on a regular basis. Every year we've had most of these have had double-digit declines in any given year. This year, we've actually had one of the lowest declines that you actually look over the last 20 years. All right. Now, when we look at the S&P 500, so we talk about that August 5th event, what's transpired since then is essentially the S&P 500 has been clawing its way back and is now above where it was on the peak of July of 2016. Okay. Or 2024, July 16th. And so what's happened is it lost down to August 5th and then bounced around. It's come up, come back down, retested a lower, and then it's come back up. Over this period of time, it's actually just been a very kind of average rate of return. It's up a couple percent over this period of time. I think I did the math. It's about 1 to 2% that the market is up since its peak in July. But what's actually changed a little bit in this period of time over the last quarter, which is really interesting. We've been talking a lot about how concentrated the markets have been with the top holdings, and those top holdings are all tech companies: Amazon, Google, Meta, Apple, Nvidia, Tesla, and so on. When we look at that, a large part of the growth in the markets over the last couple of years have been those 7 stocks. While when you look over here, since the peak on July 16th, what I've highlighted here, this is the S&P 500. This is the equal weight index, meaning that it's not concentrated in tech, it's equal weight. Well, what's interesting, it's the first time in a number of quarters where the equal weight has actually outperformed the Mega 7s. And the Mega 7 actually since then are actually down 3% as a group. So we haven't seen as much gains in the Mega 7 stocks. And what's happening is now we're starting to see, the market growth become wider. The breadth becomes wider. So now we're actually seeing a lot of the sectors that are chugging along, not just one specific sector. And this is a great example. In Q1 and Q2, this is a chart that compares the value or the growth market here in the purple, the Russell 1000 growth, which the top holdings are the big 7, against the Russell 1000 value, which would be companies like Berkshire Hathaway. It would be companies like JP Morgan. So a lot of the large cap value companies. Well, over the first 2 quarters, we saw significant outperformance with the growth companies, and these value companies lagged quite significantly. Well, Q3 saw a reversal, And actually the value companies have started to pick up. Okay. And these growth companies actually become a little bit more soft, if you would say. Now, I do believe in these companies over the long run, don't get me wrong, but the value companies have lagged so significantly over the years. There's a significant opportunity. Okay, they're undervalued. I'm going to show a chart here in just one sec. But again, definitely a reversal of fortune. This is one of the reasons we've been making changes to get more of these types of companies in the portfolio, because we want to participate with this upside. Like I said, we feel that there's this rotation that's happening. You know, we're getting institutional money that's trimming some of their profits in those growth. They're going back, buying some of these value companies that are very attractive in terms of valuations. And again, they're taking advantage of this upside, no different than what we are as well. So let's look at that. So value stocks, when we actually look at the market valuation, value stocks on the top is valued, value stocks undervalued is below. We can see that there's a significant gap of them being undervalued, a discount relative to the general broad market valuation. So we believe, just like we saw back in 2014 and 15 and 16, we think that the value companies will pick up over time. And you can see here, just coming out of 2020, we can see here that we saw that as well. But again, they're lagging significantly. And it's not just value stocks. You know, small cap stocks are the same. They're probably the cheapest they've been in almost 14 years. Now, am I suggesting everybody runs out and buys small cap investments? I'm not. I'm just saying there's value within the market outside of just the mega growth companies. And small cap stocks tend to be a little bit more volatile, but if you happen to have them in the portfolio, it's not a bad thing. Again, in terms of being inexpensive, they're quite attractive right now. And then the last piece I want to talk about with the general markets is I just want to talk a little bit about, you know, as interest rates come down, you know, talk about folks that are sitting in cash. Okay, and a lot of folks sat in cash over the last couple of years because they could get between 4 to 5%. And there'd be little to no risk on that. So why not get 4 to 5% rather than see the volatility that we've experienced here and there since 2022? Well, what's happening right now is because rates are starting to come down, the opportunity to get these types of strong yields are also waning. And we believe that interest rates will continue to be cut, and therefore the safe return, income or yield, even though it's fully taxable, will actually be a thing of the past. And we can see that since middle of or earlier 2024 to the point where they're reducing them. You know, to get a 1-year GIC today, it's about 4%. Okay, and I think by the end of the year, it'll be sub 4% to actually get a 1-year GIC. All right. So going back to my comment about value or dividend companies, you know, perhaps it's a time for you to look to rotate out of cash, depending on what your risk level is, and your time horizon is big as well. But start looking at some dividend companies, some value companies where the yields are, you know, 5, 6, 7%. Number one, they're higher than what you can get in a GIC or an interest-bearing investment. And number two, they are tax preferred, meaning that dividend income you receive is actually taxed at a lower rate than interest income. So right now, we're actually at a crossroads where you could actually get a better yield than what you can on GICs. And as we can see, there's a significant opportunity to actually capture upside or capital appreciation in these investments as well. Okay, so if you're sitting on cash, you have questions on it, you let us know. For us here managing portfolios, we do have some clients that have some cash, but we're looking to try and deploy into the markets. We don't want to sit there long term. We'd like to be actually adding some of these at attractive valuations. Again, markets are toppy right now, so we're just trying to be mindful of it. But again, a shift in your thinking, like what we're doing, is extremely wise at this point. All right, shifting gears into interest rates. We'll talk about this for a few minutes. As we all know, the inflation rate has come down both in Canada and the US. They're now actually between the 2 to 3% is what the target is. Canada's actually below that, believe it or not. It's come down sharply in the last couple months. And with that, we've actually seen interest rates come down. In Canada, we've actually seen, you know, 3 cuts now at a 1/4 point each. And in the US, we saw the first rate cut in 4 years at a nice juicy 0.5%, which is quite large. Okay. So when we look forward, I think what's happening with the markets in the US specifically, because again, they've lagged a lot of central banks around the world on cutting. what they're trying to do is they're trying to create, or they're hoping for what we call a soft landing. Okay, and what we mean by that is, by cutting rates, they don't drive the economy into a recession. We don't see excessively high unemployment rates and so on. So when we actually look at these four key factors: monthly job gains, unemployment rates, wage growth, and CPI, you can actually see they've all come down to some reasonable levels, which actually gives the US Fed some comfort in cutting rates. And this is what the end goal, this is what they're really hoping for, is with a soft landing where the economy can continue to grow, that they don't slip into a recession, and they don't start to see contractions. Okay, and all things right now is that they're pointed in that direction. Okay, notwithstanding the labor market, which I'll talk about in 1 second. The other thing we look at the interest rates, people ask me, so what do we think is going to happen in the US? So now that they got the first one under their belt, I think they'll do another one. We actually thought they would only do maybe 1 to 2 before the end of the year. Starting with 50 basis points or 0.5%, I think was a really good start. So it's possible that they could even forego a cut between now and the end of the year, depending on what kind of data comes out. But my guess would be that we could see another 25 basis point cut. Okay. And then from there, this chart just shows, the anticipated, the forecast, we can see it coming down between, late this year into 2025 and plateauing likely late 2025 into 2026. So I think we'll get down to somewhere around 3%. Will we see 0 to 1% interest rates? Likely not. That was quite an anomaly. We had that for a number of years, but I don't think they're going to be overly aggressive getting it down all the way down to 1%. And so what happens when we see a first rate cut? And I thought this was an interesting chart, and I thought I would include it. So now that we've seen the first rate cut, you might say, well, what does that mean for me in the US? Well, 3 months after the first rate cut, when we go back to the 1970s to as recent as 2019, there's 13 years here. 46% of the time after 3 months, markets were positive. Some significantly, others not so much, and some had negatives. But as we've moved out from 3 months to 6 months to 1 year, 70% of the time, markets are positive. And on average, they're positive roughly 5%. So I would expect, as they cut interest rates, excuse me, that fuels the economy. More money is in the economy. Therefore, it's more optimistic. It's cheaper to borrow. People can buy houses easier. They're not spending as much to service their debt and so on. So generally what happens is when they cut rates, it's really good for the economy. Now, I mentioned earlier, the one caveat to that I think we really need to pay attention on is the labor market in the US. So we could actually see since March, the labor market in general has been trending down. But the most recent data that was announced just in the last couple of weeks, we saw a significant amount of jobs that were created. Almost 250,000 jobs were reported. They expected about 150,000 jobs to be reported, kind of in line with August. So because we have this significant jump in the labor market, the US Fed may be a little bit more reserved in cutting. And that's why I said earlier, I wouldn't be surprised if they maybe even skip the next one, potentially. But I read a good article today. I know they're ready to really support the economy and do more rate cuts. But again, this I think is going to be the wild card in terms of how much they'll be able to cut here in the short term. Okay, so time will tell. Canada, we think we'll get one. The US, we may or may not get one. But in general, everything's pointing in the right direction. Obviously, inflation numbers are coming down. I know some folks on the call might say, yeah, Wes, the inflation numbers are coming down. But going to a grocery store and buy, your week's worth of groceries, and you can tell inflation is still high with the cost of groceries and other goods as well. But on paper, it's going in the right direction, which is positive for the economy and the markets. All right, so we're going to switch into gears again and talk about the presidential election. This is a little bit of a touchy topic. I do have one chart in here, and I'll preface it now. I'm not usually one to talk about politics in general. I tend to shy away from them a little bit. But I will start with one in general. I'm not suggesting, just to be clear, I'm not suggesting Harris will win. I'm not suggesting Trump will win. what I'm suggesting is it's anybody's guess right now. It's very tight. This was an interesting chart that I came across. It's just a couple days old. And what I liked about it is actually showed when Biden dropped out, you know, the significant, he was behind quite a bit from Trump. And we can see that. And it was no surprise, especially after the debate. Well, since he's dropped out, tides have changed quite significantly. It's no surprise. But again, any poll that you look at, it's very close. Some have Trump ahead, some have Harris ahead. Regardless of what happens, like I said, I don't think anybody can predict, you know, who's going to win coming out of the election next month. But really, for me, when I look at it, I just think, how is it going to impact me? How's it going to impact the markets? Okay, regardless of who's leading the country, everybody has a desire of who might run the country. But at the end of the day, you know, regardless of who gets in, how does it impact us? So this is just a reminder. I talked about this previously. Generally, as we get closer to the election, volatility ramps up a little bit. And we're seeing that now. You know, we're just under 1 month prior. So we can see on this chart, when you go back over the last number of decades, the most volatile period is 1 month before and 1 month after. So good reminder, if we happen to see a little bit of the choppiness, I wouldn't be surprised by it. Okay. Now, what happens when we look at year 1, 2, 3, and 4? What's really interesting here, and this is what I mentioned, what happens to the S&P 500 when somebody gets elected? We do have some periods on the red side where we have negative returns in the market, but in general, we have more positives. And the average S&P return in year 1, 2, 3, and 4 is just under 9% in general. Okay, so again, regardless of who gets voted in, we generally see positive returns in the market, historically speaking. And then when we look at, you know, party control, whether it's the Democrat or Republican, and we look at the returns, same thing, whether it's controlled by the Republicans, Democrats, or it's divided, you know, obviously, if you happen to have the same party as the president, as who controls, you know, the House, it's a little bit easier to get things approved and returns can maybe be a little bit stronger. And that's the case for both of them. But when we have it divided, you know, again, returns actually are stronger, believe it or not. And again, when you have the opposing, I mean, even when you look at it from a Democratic point of view, it's a little bit more underwhelming. But regardless, the outlook is positive, which is interesting. Okay. And then just one last piece. I talked about value a couple of times. Coming out of the election, again, just a reminder, you know, value tends to do a little bit better as we come out of the election. You know, growth companies tend to actually do a little bit, or tend to be a little bit more sluggish. Now, we are going through a period of all this tech growth, the period of innovation with AI, chat, and so on. But that being said, you know, I still think, you know, value companies should actually do quite well, especially with rates coming down. Earnings are actually ramping up and them being undervalued. I just can't help but think that they're going to have a decent little run, and they're going to pay you some income as well, which is ideal. All right, so just some year-end tax considerations, and I'm just going to have a look here. I have a couple questions that I will come back to after. If you do have questions, feel free to actually put them in the Q&A box that you can find generally if you're on a computer at the bottom. I actually have 2 questions, which I'll come back to one sec. Okay. So some year-end tax considerations. So just folks, like I said, we have what did I say? We have about 10 weeks between now and the end of the year. So there's a few things that we're going to look at, all right, which we do generally every year. So number one, we're going to do some tax loss harvesting. So what we mean by this is that if we have any positions that are significant enough, we can trigger some capital losses or realize capital losses. Benefit for that, that'll reduce your capital gains that you've triggered throughout this year. Or the other benefit is if you have more losses than gains triggered, you can carry forward those losses forever, okay, and use them in future years. So here's an example. I'll just give 2 banks, okay, TD Bank and Royal Bank. If you own TD Bank, and let's say you're down $10,000 on it for whatever reason, you could sell TD Bank and buy Royal Bank. So you're both owning financial companies. So we still believe in the sector. We can still own a similar type of company. But now that $10,000 is on paper, you haven't lost any money, but we've just triggered that potential unrealized capital loss that you can actually utilize to reduce taxes, whether this year or in future years. So that's number one. We're going to do some tax loss harvesting. We do it pretty much every November into December. Okay. Number two, for those individuals here that have low income this year, it may make sense for you to do what's called a registered plan withdrawal. And so what I mean by that is in future years, if your income is going to be higher, then what we can do is take money out of an RSP or a RIF or what have you, trigger tax on it. So you pay some tax today, but you pay it at a lower tax rate than what we feel it's going to be in the future. And for folks that have very little income, it's even better because, you know, in BC, we have roughly the first $14,000 to $15,000 that we make in BC, we don't pay tax on. It's our basic exemption level. Okay. So again, there's some planning there to actually just move money out. There might be some withholding tax if you happen to have an RSP, but you're going to recoup that when you file in April of next year. Okay. Number three, you might want to trigger capital gains. I talked about capital losses, but in some cases, you might want to trigger capital gains. And it's probably a little bit more of a strategy this year than in years past, because as most of you on this call know, capital gains, the capital gain inclusion rate changed this year. Okay. And so what it did on the personal side is up to $250,000 of realized capital gains, you pay the same 50-50. So the first 50% of the gains that you receive up to 250, you pay tax at your marginal tax rate. Okay. So as an example, let's say you have $200,000 of capital gains. Okay. Half of it's taxable, which is 100,000. And then whatever your marginal tax rate is. So if it's at 50%, you pay roughly $50,000 in tax. Okay. Now, the new rules, just as a reminder, anything you trigger up to 250 is under the old 50-50. Anything above and beyond 250, you're actually going to pay at 2/3, 1/3. Okay. Which means you're actually going to be paying more tax on the money that you make above and beyond 250,000. Now, some of you might say, I'll never trigger $250,000 in capital gains. Well, if you happen to have a house, second property, cottage, you happen to have some stocks with big gains on it, it's possible that you could. So this is the reason why you might want to look at and trigger some of them this year, and then maybe some more next year and the year after or so on. And the other thing is, again, it's just, if you happen to be having a portfolio that has significant gains, you know, even come estate time, you might say, hey, I don't want to trigger everything when I pass away. I want to try and trigger a little bit along the way. Okay. Pay tax a little bit along the way. So again, we can chat about that, but again, it's something that we want to consider again this year. And then the last one, charitable donations. You can do it in kind, or you can write a check. If you do it in kind, again, going back to capital gains, if you have an investment in a non-registered account that has a capital gain on it, you can actually donate that in kind, that whole amount in kind, and you don't pay the tax on it, but you get the full tax deduction receipt, or the charitable deduction receipt. So what I mean by that is, if you have an investment that you bought for 50,000 and you've gained 50 and now it's worth 100,000. If you were to sell the 100,000, you pay tax on the 50, and then you would actually contribute whatever else to the charity if that's what you're going to do. The other option is you can actually donate that stock, that $100,000 of stock with the $50,000 gain on it. You can actually donate that in kind to the charity of your choice, or maybe you do 50,000 or 20, whatever it is. But now that gain, you don't get taxed on that gain. That now goes to the charity. You get the charitable receipt for that full amount, and you actually eliminate that personal taxation on it. Okay. So again, just a couple of different tricks. There's more than this besides just some tax considerations, but here's the 4 key ones. Like I said, these are the ones that we see most common. Okay. So I'm going to actually open it up for some questions. I have some here, so I'm just going to go through it. And just hang tight. I'll go through it. So the first one, somebody said, what is FOMO? FOMO is fear of missing out. You hear that a lot. My daughter is 20, believe it or not. For those of you that might not know, she's 20 now, which is unbelievable when I think about it. But it's a big word with them, fear of missing out. You know, they want to be part of everything. You know, they don't want to be sitting on the sidelines. So, so someone else here asked about investing. Do we help with taxes as well, or do I need to have my own accountant? So it's a good question. We don't actually file taxes at this moment here. Okay, we actually collaborate with some great tax professionals here in the industry, so we can help or introduce you to folks. If you're already working with an accountant, we often will collaborate with those accountants. We're very well versed on the various tax considerations, Tax Act, and so on. So a lot of times what we do is we will actually advise our clients on what they should be talking to or talking about with their accountants. And then if we have to jump on the call, we'll have to often do a three-way call to chat about what our suggestions might be so they can get it implemented. So again, tax professionals, investment professionals, legal professionals, I think to have a truly solid team around you, you need one of each. And if you have a good CPA, then even better. And if not, we can actually put you in touch with some phenomenal ones here within the city. So, and then just some small cap stocks. Yeah, so again, we don't really get into a lot of specific small cap shares on a one-off basis. We can, but generally we'll actually access them through maybe a small cap manager, small cap ETF, where we're actually making tactical trades to actually get into them. What I find with some small cap individual stocks, a lot of them you'll actually find, where they're up and coming stocks. They have, up and down earnings. So like I said, it's a little bit more difficult to truly diversify a portfolio amongst the number of small cap shares. Sometimes they don't trade very freely. So what, again, we'd rather do is actually own them, whether through a pool strategy or an ETF, again, being tactical in nature, and be more diversified, because generally we're not adding a significant portion of the portfolio into these areas. But there is a way to get it done. If it's in the US, we can also generally get access to hedge versions of the investments. So the benefit for us here in Canada, we can actually get the exposure and eliminate some of the currency exposure, which is kind of advantageous as well. So let me just see. I got one more. I have somebody asking. So any comments on the geopolitical risks and also what we're seeing in China, which I think are both very good questions. So obviously, we just marked the 1-year anniversary of obviously what was going on in Israel. It's really unfortunate, and in any global unrest it's a shame to see. Obviously, we have 2 wars, significant wars that are going on. But as I mentioned before, I think the markets have largely digested, what's going on. Unless we see something that's, catastrophic or unexpected, I don't anticipate, the stock markets to change that much. But again, if it escalates, that's where the uncertainty could have a fairly significant impact, I think, in the short term. Long-term fundamentals will prevail. With respect to China, we saw a fairly significant stimulus package within the last month or so. And as a result, we saw the Chinese stock market go from pretty much flat for the year up 20 to 30%. It saw a significant upside. And this is what stimulus does. And this is the way that some of these Asian countries, this is how they stimulate their markets, is they have cheap money with that big stimulus packages that really drive the economy. Well, what's happened over the last couple days is the luster is coming off there. And so what we're seeing in China is they were down, I think, 7% today. It was the worst drop since we've seen since COVID. So the problem is that investors, what they're saying is, hey, I want more. I want more. I want you to keep on giving us the goods so that we have more and more stimulus to actually prop up the economy. And because they don't anticipate other significant stimulus packages, that's why the markets are rolling over. So this goes back to that question earlier about FOMO, or fear of missing out, which was a great question. Here's where we might get some folks that will say, hey, I got to invest in China. Look what's going on. Look at the gains. I don't want to miss out. And what happens is you tend to invest as you get to the peak, and then it rolls over and you're left kind of holding the bag, and then you're stuck with a loss. So those returns in China right now are really artificial. Whether it'll be prolonged or sustainable, time will tell. I'm not quite sure as of this point, but we're watching it closely. But it's like I said, it's a little bit of a slippery slope, because again, it's artificially propped up right now. I'd sooner be in here in North America, or maybe even in Europe a little bit, but more developed investments rather than speculative in nature. Okay, well, listen, I think that's all about the questions. I have a couple other questions. What I would suggest is just send us an email. I'm happy to chat about this a little bit further. Unfortunately, I can't reply on the system. So if you want to actually send me an email, My email is washton, so WASHTON at harbourfrontwealth.com. So just what's on the screen, harbourfrontwealth.com, but Ashton at harbourfrontwealth.com. Send me an email with any questions I might have missed, and I'd be happy to provide those specific comments. So again, thank you very much, folks. Have a wonderful and a happy Thanksgiving. Hope everybody has saved room for the turkey and dessert. I know for me, I'll be hosting my family on Saturday. I'm cooking for about 10 to 12 people. Looking forward to it. I'm going to pick up my bird, I think, tonight. And we'll have the full meal deal. So anyways, for all of you, like I said, I hope you have a wonderful weekend, wonderful Thanksgiving. If there's anything that anybody needs, please don't hesitate to reach out, give us a call, send us an email. In the meantime, enjoy the rest of the Wednesday and the rest of the week, and we will talk to everybody soon. Take care. Thanks, guys.